Okay, in this video, I want to show the effect of an error. In this example, this company in its first year of business erroneously recorded a period cost as a product cost. What does that even mean? Product costs are all costs to get your inventory in place and ready to sell. What happens when you have a product cost is it increases your asset inventory. And then as your inventory gets sold, it eventually gets expensed. A period cost does not relate to the getting your asset in place and ready to sell. These are your selling, general, and administrative costs. So think about a product cost. Those are all the costs. If you had, say, two buildings, one's the factory where you make all your goods. All those costs are part of your inventory initially. And the other building, which is the corporate headquarters, all those are expense. They are not part of the making of your goods. So in this case, what's happened is that they overstated their product cost and they understated their period costs. So if I can have you look at this, this is 500 too low. So understated by $500. We should have expensed this by 500, right? Now, if none of the inventory had been sold, this would be overstated by 500. This would be understated by 500, making this overstated by 500. But what's happened is 60% of the inventory has been sold. So this 500 that was too high on your balance sheet initially, there's only 40% left of that. So this is equal to your 40% times the $500. So that, oops, sorry. So $200 of your inventory is overstated. The rest of it has gone out the door as cost of goods sold. So it's been sold. So 60%, this way, 60% times your $500 error is in your cost of goods sold. So in other words, you had increased inventory by 500. That 500 though, 200 of it's still there. 200 is still in inventory, but 300 of it has been expensed. That should not have even been part of cost of goods sold. So if you look at this, our cost of goods sold is overstated by $300. So in other words, that should have been part of this expense. So if our cost of goods sold is too low by, too high by 300, but our other expenses, SG&A, is understated by 500, do you see that our net income is, overstated by that difference? So in other words, a whole 500 should have been expensed and it wasn't. So our net income would be 500 too high, but we overstated 300 of our cost of goods sold, making operating income overstated by 200. Now, on the balance sheet side, this is overstated by 200, too high. So if you think about the balancing of the accounting equation, assets are too high by 200, inventory, and then income becomes part of retained earnings. So your shareholders' equity will be too high by 200. But there's this intermediary step, this multi-stepped income statement. What about gross profit? Well, if your sales are fine, because we're not going to, this is not an error with the price we sell our goods to our customers for, it's the costing of that. We put 300 too high in cost of goods sold because it should have all been selling, general, and administrative expenses. So that means if this is too high, then this is understated, not by 500, but by 300. So this may seem a little confusing. That's why I did this second, but basically this is too low by 300, but then this is too low of an expense, 500, making this too high by 200. If it had been the opposite, where they called a product cost a period cost, what that means is they expense too much here and that these are too low, and it has the opposite effect. So I hope that helps. you'll have that on your project. So you'll want to make sure you understand this.